September 15th, 2008. It was a Monday morning, cool, gray, over Manhattan. But that chill, well, it wasn't just the weather.
No, definitely not.
That was the day Lehman Brothers filed for Chapter 11, a 158-year-old giant, $639 billion in assets, just gone. The largest bankruptcy in U.S. history.
And the images, the stock market tanking, the panic on the news, that was just the surface. The real fear, the absolute terror was hitting the invisible plumbing.
The credit markets.
Exactly. Where banks lend to each other constantly, every single day, overnight. That just stopped. Froze solid. Suddenly, nobody trusted anyone else. How much exposure did they have to Lehman, to these toxic assets?
Right, the system had a heart attack.
A massive one. And the crucial point, I think, is that Lehman wasn't the disease itself. It was a huge catastrophic symptom. This firm survived the Depression, world wars.
But not this.
Not this buildup of risk. So today, we're going to trace that back, not just months, but decades. How did these innovations designed to reduce risk actually end up concentrating it? And how did it all unravel so fast?
Okay, let's start with the basics. The mortgage. For ages, it was pretty simple, right? Local bank, local borrower.
Right, the old originate to hold model. Your savings loan or your bank gave you the mortgage, and they held onto it for 30 years. They cared if you could pay it back because they held the risk.
They had skin in the game.
Total. Then 1970, Ginnie Mae introduces securitization. The idea, initially, was good public policy. Free up bank capital, make mortgages easier to get, boost home ownership.
But Wall Street saw something else. Louis Ranieri at Lehman Brothers. That famous quote.
Ah, yes. Mortgages are math. That changed everything. Suddenly, it wasn't about a family buying a home.
It was just a stream of cash flows.
Exactly. Abstract numbers, probabilities, something to be sliced, diced, and speculated on. That's the birth of the mortgage-backed security, the MBS.
But the early MBS had this problem investors hated: prepayment risk. If interest rates dropped,
everyone refinances. And the investor gets their money back right when they don't want it, because where can they reinvest it at a good rate? It messed up their expected returns.
So Wall Street needed another trick.
And they found one. 1983. The Collateralized Mortgage Obligation, or CMO. Lawrence Fink, who later started BlackRock, was involved in one of the teams that developed this.
This is the tranching, isn't it? The waterfall structure.
That's the one. You take this big pool of mortgage payments and you carve it up. Senior tranches get paid first, mezzanine next, then the riskiest bit, the junior or equity tranche, gets paid last and absorbs the first losses if homeowners default.
So you're isolating the risk, pushing it all down to the bottom.
Precisely. And here's the kicker. Because you've concentrated all that potential loss in those small junior pieces, you can plausibly, mathematically argue that the huge senior tranche is incredibly safe.
AAA rated safe, even if the underlying mortgages weren't perfect.
Correct. They could manufacture enormous quantities of AAA paper this way. And pension funds, insurance companies, conservative investors all over the world were desperate for safe assets that paid just a little bit more than rock-solid treasury bonds.
It seemed like free money. A slightly higher yield, same AAA rating. What could go wrong?
Well, what could go wrong was the assumption built into the models. They were based on historical data that never, ever saw a nationwide fall in house prices. They assumed defaults were localized. A downturn in Ohio wouldn't affect California.
Like isolated house fires, not a forest fire.
Exactly. They missed the systemic risk, the fact that the whole country could go down at once. So the safety was an illusion. The risk wasn't gone. It was just concentrated, waiting.
And for this whole machine to keep running, it needed fuel, lots of mortgages, and it needed the rule book to be rewritten.
Oh, absolutely. Deregulation was key. And it was bipartisan, happened over years. Two big ones stand out. First, Gramm-Leach-Bliley in 1999.
That killed Glass-Steagall.
Right. Glass-Steagall had separated plain old commercial banking, taking deposits, making loans from the riskier world of investment banking, which trades securities. Gramm-Leach-Bliley tore down that wall,
leading to these giant financial supermarkets like Citigroup. And the risky trading culture started infecting the deposit-taking side.
You got it. Suddenly, the part of the bank holding your savings was merged with the part making huge bets in the market. The potential conflicts, the scale of risk, it ballooned.
Okay, what was the second big one?
The Commodity Futures Modernization Act of 2000, the CFMA. This one may be even more critical. It essentially created a regulatory black hole for something called over-the-counter derivatives.
Privately traded contracts outside the main exchanges.
Exactly. And the most important derivative hiding in that black hole was the credit default swap, the CDS.
Okay, let's just clarify CDS quickly. It's like insurance.
Sort of. It's insurance on a bond, or in this case, often on those mortgage-backed securities or CDOs we'll get to. If the bond defaults, the seller of the CDS pays the buyer the face value.
But the dangerous part allowed by CFMA was
you didn't need to own the bond to buy the insurance. You could take out fire insurance on your neighbor's house. It became pure speculation, a way to make massive, unregulated bets against the housing market or against specific securities.
wow. Okay, so you have deregulation opening the gates, and then you have Alan Greenspan at the Fed.
Yeah, cutting interest rates down to, 1% by 2004? Flooding the world with cheap money? This intensified that global search for yield. Everyone needed somewhere safe to park their cash that still offered some return.
And Wall Street was ready with those AAA-rated MBS and CMOs.
They were. But that demand had a catastrophic effect back down the chain. It flipped the mortgage origination model completely.
From originate to hold.
Originate to distribute. And this is absolutely crucial. If you're a lender like, say, Countrywide Financial or New Century,
And you know you're just going to sell that mortgage off to Wall Street in a week or two.
why bother checking the paperwork too closely? Why verify income? Your incentive is purely volume. Get the loan done, collect your fee, pass the hot potato on.
The risk is someone else's problem.
Completely. Underwriting standards just evaporated. Quality went out the window. It was all about quantity, feeding the securitization beast.
And that's where the really toxic stuff comes in, the loans that hit Main Street hardest, like the 228 ARM.
Ugh, yeah. The adjustable rate mortgage. Low teaser rate for 2 years looks affordable. Then it resets, jumps dramatically higher, often precisely when the borrower couldn't refinance because house prices had started to plateau or fall.
And the lender who made the loan, they were long gone. They'd sold it off.
Sold it off, booked their profit, and then the absolute nadir, the NINJA loan.
No income, no job, or assets. It sounds like a joke.
It practically was. These were stated income loans, often called liar loans. Borrowers didn't have to prove their income. Mortgage brokers, incentivized by volume, routinely inflated incomes, invented assets, anything to get the loan approved and feed the machine.
Okay, so the quality of mortgages is plunging. Wall Street must have noticed they were packaging worse and worse stuff, right?
They did. And eventually, investors started noticing too. Particularly those middle tranches of the MBS, the ones rated BBB or A, the slightly riskier ones. They became harder and harder to sell. Toxic waste started piling up on banks' books.
A bottleneck.
A big one. So Wall Street's solution, more financial engineering. Enter the Collateralized Debt Obligation, the CDO.
How did this work? What was different?
Okay, they took hundreds of those unsellable BBB-rated MBS tranches, the stuff nobody wanted, pulled them together.
Wait, they pulled the risky stuff?
Yes.
Yeah.
And then they applied the same tranching logic again. They argued, look, these BBB bonds come from mortgages all over the country. They're diversified. So if we pool enough of them, the top slice of this pool must be super safe.
So they took literal junk, bundled it, and somehow created new AAA-rated securities out of it.
That's exactly what they did, turning lead into gold or maybe garbage into gold. The CDO became this voracious artificial buyer for the riskiest slices of the MBS market.
Wow. As one banker apparently told the crisis investigators, when they couldn't find buyers for the BBB stuff, they just created the investor by building a CDO.
That quote sums it up perfectly. It created this perverse feedback loop. The demand from CDOs encouraged lenders to originate even more low-quality mortgages, because now there was a guaranteed buyer for the resulting toxic waste. The CDO was the engine driving the whole destructive supply chain.
And just when you think it can't get crazier.
It does. The synthetic CDO.
This one always melts my brain a little.
This is
Explain this ghost in the machine.
Right. A synthetic CDO didn't hold any actual bonds, any MBS tranches at all. It was composed entirely of credit default swaps.
The insurance bets we talked about earlier.
Exactly. It was basically a portfolio of bets referencing real CDOs or MBS tranches. Think of it like this. If a real CDO is a car in a race.
The synthetic CDO isn't another car.
No, it's just a massive stack of betting slips placed on whether that original car will crash. And crucially, there was no limit to how many betting slips you could write referencing the same car.
So you could have one $10 million tranche of risky MBS.
And potentially hundreds of millions, even billions, in synthetic bets referencing it. It allowed the potential losses in the system to multiply exponentially, far beyond the actual value of the houses or mortgages involved. It was pure, leveraged betting on failure.
Okay, none of this works. None of this gets sold to pension funds without the blessing of the gatekeepers, the credit rating agencies, Moody's, S&P, Fitch. What happened there? It seems like a colossal failure.
Colossal is the word. It boils down to a few things. First, a massive conflict of interest. The issuer pays model.
Meaning the banks creating the CDOs paid the agencies to rate them.
Exactly. So if Moody's got tough, the bank could just take its business down the street to S&P. It created intense pressure to deliver the AAA ratings the clients wanted. It was called rating shopping.
And the models they used, we touched on this, they were flawed.
Fatally flawed. They relied on historical data that, again, never showed a nationwide housing price decline. They assumed low correlation between regions that Florida crashing wouldn't affect Arizona.
They missed the one big risk that tied everything together.
The systemic risk. That lousy underwriting standards and exotic mortgages were everywhere, fueled by the same securitization machine. When prices stalled and fell nationally, all those supposedly uncorrelated assets defaulted together. The agencies, as the Financial Crisis Inquiry Commission concluded, were essential cogs in the wheel of financial destruction, stamping AAA on toxic waste.
So the fuse is lit. When did the first real explosion happen?
Summer of 2007. Two big hedge funds, run by Bear Stearns, heavily loaded with subprime MBS, suddenly collapsed. Billions wiped out. That was the first public flashing red light that the AAA ratings were, frankly, garbage.
And that set the stage for the big one, September 2008.
Right. The government had already stepped in to bail out Fannie Mae and Freddie Mac earlier that month. All eyes were on Lehman. The government, particularly Treasury Secretary Hank Paulson, seemed determined to draw a line, avoid moral hazard, bailing out risky behavior.
So they let Lehman go bankrupt on September 15th.
A catastrophic miscalculation. They underestimated how interconnected Lehman was, especially through that opaque web of derivatives, the CDS contracts. Its failure triggered defaults and panic globally.
And they realized their mistake almost immediately, didn't they?
Within hours. The very next day, September 16th, AIG American International Group, the world's biggest insurer, was on the brink. Why? Because they had written hundreds of billions of dollars worth of CDS insuring those toxic mortgage bonds.
If AIG failed,
it would have been Armageddon, a cascade of failures across the entire global financial system. So the Fed reversed course instantly, an $85 billion emergency loan to AIG, effectively nationalization. The stand against moral hazard lasted less than 48 hours.
Then came TARP, the Troubled Asset Relief Program, $700 billion.
Yeah, initially the idea was to buy up the toxic assets, but that proved too complicated, so they pivoted quickly to injecting capital directly into the banks, shoring them up.
Necessary maybe to stop a full meltdown.
Most economists think so. But the optics were terrible. Taxpayer money bailing out the banks that caused the mess, while millions of ordinary people were losing their homes to foreclosure.
That generated incredible public anger, didn't it?
Absolutely. Huge distrust. That feeling of socialism for the rich, capitalism for the poor, it directly fueled movements like Occupy Wall Street on the left and the Tea Party on the right, a deep anti-establishment anger.
And let's not forget the human cost. This wasn't just numbers on a screen.
No. The Great Recession officially cost 8.7 million jobs in the U.S. Unemployment hit 10%. Something like $13 trillion in household wealth just vanished. People lost homes, savings, futures. Stories like Sheila Ramos ending up in a tent, Jennifer Butts facing bankruptcy over her exploding mortgage. That was the reality for millions.
So after the fire came the attempt to rebuild the fire code, Dodd-Frank, in 2010.
The biggest regulatory overhaul since the Great Depression. It tried to tackle a lot of these problems, created the Financial Stability Oversight Council, the FSOC, to watch for systemic risks and designate firms as too big to fail.
Set up the Consumer Financial Protection Bureau, the CFPB, to fight predatory lending.
Introduced the Volcker Rule to limit banks gambling with their own capital, so-called proprietary trading.
Yeah.
And that skin in the game rule, trying to fix the originate to distribute mess by making securitizers hold on to 5% of the risk.
So the big question, are we safer now?
It's complicated. Yes and no, or maybe, yeah. But banks definitely have bigger capital cushions now. They're probably more resilient individually.
But
a lot of the risk is just moved, squeezed out of the regulated banking sector and into the less regulated shadow banking world. Non-bank lenders, private equity, hedge funds. They're doing a lot of the lending now, especially riskier stuff like leveraged loans packaged into CLOs, collateralized loan obligations, sort of the corporate cousin to CDOs.
So the risk hasn't disappeared, it's just harder to see. And the biggest banks are actually bigger now than they were in 2008.
They are. Which raises questions about too big to fail. And politically, the legacy is profound. That collapse of trust, the surge in inequality as the recovery favored asset owners, that K-shaped recovery really defined the last decade or more.
It feels like the specific weapons of 2008, the subprime MBS, the CDO squared, might be gone.
They mostly are, but the human factors, greed, the desperate search for yield in a low-rate world, hubris, forgetting the last crisis, those are constants. The fundamental drivers haven't changed. The seeds for the next crisis are probably being planted right now.
Which leaves us, and you listening, with a sobering thought. If the risk is migrated into these darker, less transparent corners of the financial system, the shadow banks, what will that next crisis look like? And will we even see it coming until it's too late? Something to think about.